Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Judd Hirschberg back on the program show. Judd is president at White Wave Trading, a trading company and our partner for trading research consulting services at Cedar Gold. He has run proprietary trading groups, has over 45 years of trading experience, has developed some awesome indicators and a repeatable process-based approach. That's the important operative here, a repeatable process-based approach for trading the financial markets. Prior podcasts with Judd have focused on his approach and methodology and updates on the financial markets. And today we'd like to understand what Judd has currently seeing in the financial markets across asset classes and jurisdictions. Welcome, Judd.
Thank you, Richard. It's always a pleasure to be back.
Great. Just thought we'd begin maybe with the equity markets, where you see the potential for going there. Maybe at the outset to mention, you see some very big changes that have happened in terms of 40-year bull market in equities that you see it now as a bear market, and also the opposite on bonds. Did you want to show that and talk about that a bit?
Sure. Let's. Is my 2-year chart showing up for you?
Plaza Core Channel, opening.
Yeah. Okay. Yep. All right. So this has been 6 months ago. More than last summer, we started talking about this with Ira, about interest rate differentials, the dollar, and how interest rates were going to run the world. We've been in a 40-year bull market for lower rates and a 40-year bull market in equities since 1982. We use risk spreads, meaning the divergence in the bonds versus the equity markets, to give us short-term trading opportunities to medium-term trading opportunities. But if we just take a look at the 2-year today, it's at, I think at one point it was up at 397. This is a Plaza Core channel from January 1985. All currency movements are measured from 1985. Anybody who doesn't measure their currencies from 1985 has no concept in trading currencies. They don't know where they are, where they've been, what they're doing. They just, no concept. At some point, I think you're going to see 7% in the 2 years. Now, when that is, I can't tell, but I know that, there's going to be a couple levels up here at there's room for another full point in the 2-year. Now, how we get there is another story, but we're going to have a pretty good idea after tomorrow's Fed meeting, whether they're going to be on hold for a little bit and everybody wants to buy the dip and before the election and have one more false rally, or they just keep their foot to the floor and the higher rates keep running the equity markets. So this is here. Let's just go and take a look at the bonds. Is this up on your screen?
Yep.
Okay. So the bonds have been this morning. A lot of mornings you come in and the S&Ps might be higher, but when you start going into London's opening, the European interest rates start taking over. This isn't a small thing that's going on here with European debt. Yeah. There are the bonos.
Massive historic change.
The Italians haven't been around as much, but the Italians actually closed below their opening range. Or right on it. Where was their opening? 115.20 was the opening range of the Italian bonds. And they went up at 115.44. They start closing under this, they're going to do a whole nother swing down.
Wow.
Much higher rates. So this is the kind of thing that we, I like to focus on the longer term stuff to get an idea of what we can do.
Yeah.
Let me pull this apart. So as it relates to the metals, the gold is flirting with 1673.30, which is the yearly ORL reversal number. We start closing under this under the quarter, and you're going to probably have a good sense of it tomorrow afternoon. We start coming down, there's plenty of room for the gold to break. And if you look at the shorter time frames, at least $100, maybe a lot more.
Wow.
So, if you're going to get 4% on a 2-year note, why do you want to own gold, which doesn't give you a return? So then let's look at the S&Ps. All right, the S&Ps have been going up since October 1982. The first week in October in 1982, the S&Ps broke out of their opening range at 116. Think about that, at 116.
Yeah.
As far as I'm concerned, the S&Ps have topped for a while. Now, this is the 30-year bond futures. And this is what I mean, that these things, it's the same chart the opposite way. Interest rates bottomed in 1984 and have been going up, have been going lower ever since they topped in January of 20. Now, this has turned into a bear market in the bonds, and it's totally broken out to the downside. I'm looking for at least 117 in the futures and about 4.5 in yield in the 30-year.
Could there be a retest of the channel at some point?
Sure. I mean, you could get one, depending upon the Fed meeting tomorrow. I mean, it's all a sentiment thing. If everybody thinks that the Fed is not going to keep, and Ira brought up the point, are they really going to raise again going into the November elections? So, if they hold off, or they say they hold off in the language, and they're, a lot of people have been writing articles about them wanting to just wait and see a little bit.
Yeah.
I think that'll cause a big relief rally and all this stuff. And wherever the bonds go, the metals will go, the indices will go. It's all the same trade. It's follow the 2-year yield or the 30-year yield. And the yields are running it. It's not anything else.
And over the last several months, you mentioned you're more interested in the indices rather than individual names on the equity markets?
Yes. So for the last decade, the names were great trades, and they were, if I looked at Apple or I looked at Microsoft or Amazon or Google, they'd match up with the indices perfectly on the lows and the highs. And that was when, rates were going lower and you were still in that growth mode. where everybody was trading growth. Now it's more of a distraction to try to spend the time to look at all the individual names to see if they're lining up with the indices, because the indices right now are an easier trade. So, I prefer to focus on what's the easiest trade. And with, 1 or 2 50-point moves a day in the S&Ps or more, there's no reason to focus on an individual stock. Unless you're an options trader and that's your thing, that's fine. But for my room, I'm trying to get the guys to focus on the easier trades.
Mm-hmm. And for S&P 500, do you have potential or target numbers, short, medium, long term?
Well, the S&Ps, I think at some point are going to come back, and they already got the stops the first time down here at 36.52 and a half. That's an ORL year. That's no small thing if we put that in December.
Mm-hmm.
That means we're coming down a long ways, probably somewhere around 3,000 in the S&Ps.
Yeah.
And I'm one of these people that like to take it one level to the next. Because having a really long-term view, even though I'm bearish a lot of times right now, it doesn't help you make money.
Yeah.
We're all about making money.
Yeah. Do the other indices like the Russell 2000, are they the same type of pattern?
Let's see what I got here. Well, I still think that the NASDAQ itself never put in that higher high and rolled over. It's just in a downtrend. Mm-hmm. So it's a different technical look, but that doesn't mean it still can't come down, almost another 900 points. I mean, it doesn't even come back to trend for another 900 points.
Interesting.
Yeah. So the big trade is going to be, it's the really big trades usually set up the first week in October, midweek. And if the markets fail midweek, the first week in October, they're gone. There's going to be a big break.
That's a couple of weeks from now, you're saying.
Yeah. So you've seen it in 2018. You've seen it in 2020. You've seen it before. You've seen 500-point moves in the S&Ps starting on that week. And especially if Ira goes on vacation, I'll definitely break.
Okay.
So send them away.
Okay. Any thoughts on the currency markets like the Japanese yen, the euro, US dollar?
Okay, we can look at the euro here. All right, this is what I'm talking about. There's 1985. There are the Plaza Accord fibs. The euro wants to trade like 96.20. The problem with the euro is that everybody's buying euro, selling yen, selling pounds, selling Aussie, Kiwi, all the commodity currencies. Excuse me right now. So, while I believe it's going there, and then a lot lower. I think we'll eventually get into the 80s. Especially if the interest rate differentials, if the Fed stays on a with a tightening bias,
yeah,
It'll eventually go. It's just not ready yet. Dollar yen, I have the potential for this to go to 222.
Wow.
I don't know what kind of world we're living in there if it goes there, but earlier in the year, I had a target off the 98 intervention in the I don't know, 132 to 134 area. And we're still going. So I'm not going to get in the way of that. Interest rate differentials are going to rule the trade. The pounds, the 1985 low shows 104.63. I covered shorts at 103.65 in the futures because there was such a big forward at the time. There was almost a two-figure forward. And I don't see why we can't go back there. Aussie, again, that's just growth. And you really have to get into the crosses. So you can see euro yen, they're buying euro, selling yen. This already went to its target. Here, where is the target? 149.29. It went there once. It's trying to go there again. Starts closing above it, it's going to go again. So you really have to look at these the crosses when you're trading the currencies, because anything else is just you won't get a clean look on it. Pound yen. So you have to look at all the yen crosses. Ira likes to look at Euro Swiss. That could easily come back down here to 85. And then we have, the commodity trades going on, which are completely different. Here you had the wheat double topped up here. It made a lower high. Anytime you see something like this on a long-term chart, make a lower high like that and then come back down, it might never go back up there. So now you're waiting for another setup. And this is the Kansas City hard red wheat, which the hard winter wheat, which is the same wheat that they have in Ukraine.
Yeah.
So that's why this is a better contract to follow than the Board of Trade contract, which trades 70 cents lower. So this this is a bullish pattern on the weekly in the wheat. But we need over this 200-day moving average. So if we start seeing sustained closes over 970 in the Kansas City wheat, especially a weekly close over it, then you can get another rush into some of these grains.
Yeah.
In the meantime, I don't think you can initiate a position here. It's a better exit than it is an entry.
What's that? And any other observations on the agricultural commodities?
I haven't been on top of it as some of the guys in the room have. And one of my longtime clients told me he's been trading coffee. He's been doing really well. And that looked bullish.
Yeah.
But when you look at the longer term charts, it's hard to see how that moves higher, but doesn't mean it can't.
Any thoughts on the industrial metals like in copper?
Well, we talked about it yesterday or the day before when Newmont took off.
Yeah.
And Iris sent me a note at night. He said, how can that be? And the next morning, everybody bought BHP, Vale, Freeport, Southern.
Yeah.
Because they all thought, okay, the Fed's not going to raise anymore after this rate rise. And they all bought it. And then, it turned around and rolled over again.
Yeah.
You have to be really careful about what you buy, where you buy it. And that's why I think that the indices are a truer look right now than all these other sectors, because you're getting a lot of false signals.
Mm-hmm.
And it's turned into a lemming effect trade. Look at last Tuesday. I mean, this is just classic, okay? And this is what people don't look at. One, this is the S&P pit. So this is US session only. Gapped up, and in the morning, we were actually up here. The high was 41.75. Everybody had their orders in, I think, 8 points higher to try to sell them. And then they had to sell them at the market. That's an exhaustion gap, the third time up. 1, 2, 3. That's just classic. And it exhausted before 8:30. So you can see where we opened at 8:30. We were up here at 7 o'clock in the morning.
Yeah.
When we were in the room speaking that this was a bull trap, and it was an area where you wanted to sell them before you buy them, because it was a classic exhaustion gap in the S&Ps.
Mm-hmm.
And then boom. So, there's a lot of moving parts here.
Yeah, and what's truly great is in the trading room, typically there's discussion there's all day long on different aspects of the financial markets, and perhaps, the room is ahead of the consensus by 2 weeks to 6 months. And so the idea is to look for setups, right, to confirm before executing. But there's a lot of knowledge from a wide variety of background that we have in the room, and it's really great value. And there's usually discussion that's ahead of the game in terms of consensus, ahead of consensus. Your thoughts on that?
Well, it's been amazing, having Ira in the room and Andrew and some of these other guys and Angelo. The conversation has gotten really deep, and we know what we don't want to do, and we're just looking for certain setups.
Yeah.
And we're not, I have day traders in the room that are extremely successful. They're RIAs, they're options traders. There's another subset that won't even trade unless they can make 40 or 50 S&P points. Won't even bother clicking the mouse. And, I've always promoted that the less you trade, the more money you'll make. But the depth of trading styles in the room and everybody talking about, how they trade and where they're executing is really helpful.
Yeah, absolutely. Great. Any final thoughts or closing observations?
it's just all about whether the Fed's going to keep their foot to the floor on this, on these rate rises. I know where the rates need to go. I mean, the 30-year needs to go to at least 4.5. I think that the 30-year bond futures should get down to around 117 at some point. 117 to 118 is where they're going to catch everybody. It's another 10 points. And I'm not sure when that is right now. But I do know that we're going to get a really big opportunity going into the end of the quarter, into the 1st of October.
Yeah.
And I'm just going to be flexible with it. And that's what we've been doing. We've just been keeping our trading hats on. And, we bought the first low in the S&Ps. I don't know which one that was. In July, down in here. And it took off.
Yeah.
And it went a hell of a lot farther than I thought it was going to go. But again, it gets up to the 200-day moving average, and the S&P bond spread at the same time got up to a big resistance level, and they both rolled over together. So this is a market that if you miss something, you just have to shake it off, because you're going to miss stuff.
Well, great. That's been fascinating insight, especially these 40-year changes are truly historic. Those charts are amazing, Judd. And how can our listeners learn more about your work?
They can go to whitewavetradingstrategies.com, and they can look on my website. They can get a free trial, and I've been letting people in for a month because it takes a long time to really digest what we talk about and how we execute. And if you come in, you should ask questions. Feel free to ask questions, just type them in. Somebody's going to answer you. And whoever answers you is going to be pretty darn good.
Yep, absolutely. It's extremely high value. Thank you so much, Judd, for the discussion and update on the financial markets.
Thanks, Richard.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.